Thank you ever so much, everyone. So it's Arizona Sonoran Copper Company. The title of the presentation is Copper Invest in Sustainability. We do make some forward-looking statements, so I'll draw everybody's attention to the cautionary language. This presentation is on our website, so please feel free to view the language at your own discretion. A little bit on the share capital structure. So today, only 89 million shares issued, fully diluted 99 million. Options and warrants are in the money. Some of those will expire next May and June, so we expect to receive a little bit more money into our treasury. The options and warrants are in the money. Today we have a very clean balance sheet with no debt and approximately $23.5 million in the bank, so we're very well funded. We've got a large controlling shareholder, which is Tembo Capital, who are a private equity group out of London. They were heavily involved with Ero Copper 5 years ago, when they were a plus 20% shareholder. And for those of you who have followed the copper space, that story's did extremely well in the last 5 years. Tembo's obviously heavily involved as well in Maramaka. So they're not generalists, they're very resource orientated and have a very strong technical team, but obviously very bullish in copper. You'll notice there as well that we now have a 7% interest from Rio Tinto. They put $10 million into the company in May of this year. Initially, they wanted to put $20 million in, but it would have taken them to a 15% shareholder. We didn't think that was a good idea. We wanted to keep competitive tensions open. So they put in $10 million. They have preemptive rights. There's no board seat. They can increase their position to 9.9, but they're not allowed to go above that. And they have a seat on the technical committee. And the reason why they've invested initially is they've informed us that they have a proprietary technology which they call Newton. Essentially, it's the heap leaching of a primary sulfide, in this case, chalcopyrite. Within the £6.5 billion resource that we have today, there's 1.7 billion pounds of that, which is copper in primary sulfide, which is a stranded resource. We've no intentions of putting in a copper concentrator. This is a heap leach with an SX-EW. So, of course, it's a stranded resource. We get no value for it, nor do our shareholders. And subsequently, if they can prove the technology actually works, we might be amenable to then entering a commercial agreement with them where we both share in the upside of it. The project's located 45 miles south of Phoenix. It's at the intersection of three massive copper porphyry systems. Phoenix has a population of 4.5 million people. We're 75 miles north of Tucson with a population of 1 million people. And the city of Casa Grande is 3 miles to the east with a population of 55,000. The area is very well supported with infrastructure. Interstate 10, which connects Phoenix to Tucson, is only 10 miles to the east of the project. We've got the main Maricopa-Casa Grande highway on our southern border, and we've even got the Southern Pacific Union rail line immediately there as well. The main power line runs right through the property, 115 kVA line with excess power on it and the ability to access 100% green energy from that power line. I'm sure you're all very well aware as well that Arizona typically supplies in excess of 70% of the US domestic supply of copper. So when we first acquired this project in late 2019, the initial resource that we had was on a surface stockpile of 225 million pounds, which essentially was the waste piles when this was a producing mine back in the 70s and 80s. And at that time, ASARCO had a copper concentrator on site, and they were floating a con from the sulfides. There's two types of sulfides here. There's an enriched supergene, which is covellite and chalcocite, and there's a primary sulfide, chalcopyrite. But all of the oxide cap was regarded as waste and went onto a stockpile. And also any sulfide that was below the 0.3% copper cutoff would also go onto the waste stockpile. Now, of course, since then, with heap leaching technology today in sulfuric acid, we know that we can recover that copper from the stockpile. So initially it was 225 million pounds. The company drilled in and around the open pit, Cactus East, which is an underground deposit. We put out a PEA in 2021. The resource had grown to 3.5 billion pounds of contained copper in the ground. And recently we put out a maiden resource on Park Salyer, which is 2 kilometres to the southwest, all part of the same copper porphyry system, and we now have 6.5 billion pounds of copper in the ground. We've obtained that number through investing $40 million of pure exploration drilling expense. So our discovery cost is 1 cent a pound of copper, so it's telling us we need to continue to explore on this site. As far as independent projects are concerned, we believe this to be the third largest independent copper project now in the US of A, only behind Pebble, which may never get permitted, and Santa Cruz, which is Ivanhoe Electric at 5 million tons or 10 billion pounds. And you'll notice there on this slide, immediately in the left-hand corner, that is Ivanhoe Electric and Robert Friedland, which recently IPO'd, with today a $1 billion market cap on a greenfield site that is easily 10 years away from first production. You have Arizona Sonoran immediately to the north, $100 million market cap, water permits in hand, access to water, brownfield site, aquifer protection permit in hand, PFS well underway, strategic investor, and probably 3 years away from first production. So there's a massive valuation gap there, which over time is probably going to diminish. And there on that photograph, you can see immediately south of the Cactus Pit, that's the Stockpile project, 80 million tons at 0.17% total copper, 225 million pounds. Now, we put a PEA out in August 2021. We ran the resource at $3.15 a pound of copper. The financial and economic model was run at $3.35 a pound of copper, and it gave us an NPV8 after tax of $312 million and an IRR after tax of 33%. Now, the capex for the project back then was relatively low at only $124 million. There was something that was missing from that, however, which essentially was fixed asset equipment, namely a 2-stage crusher, conveyor, and stacking equipment. They were planning to take run-of-mine ore from the pit and underground, which would be 6-inch to 8-inch minus, put it in trucks, drive it up on top of the leaching pad, dump it on the leaching pad, and then expect the copper to be recovered. But when we went into the detailed metallurgical work as part of the PFS, we look at size fragmentation and what gives us optimum recovery. And we saw very quickly that a 3/4-inch minus to 1/2 inch was going to give us optimum recoveries. So there was a 2-stage crushing plant that never went into the capex number for the PEA. And then with today's inflationary pressures, that adds about another $50 million there. What also was missing was that you want to try and avoid running big, heavy equipment on top of these leaching pads, because a 150-ton truck is going to compress that ore. You have to come back and rip it. You don't get the permeability. You don't get the recoveries. So we needed to go with a conveyor system with stackers, which again, today with the inflationary pressures, would add in another $50 million. So if we were looking today to publish a PFS and we were looking at the true capex number fully costed today, it's $225 million. But I think we could also use a long-term copper price of $3.65, which is above the PEA. And this does not include Park Salyer, which I'll jump onto shortly. So when we looked at the PEA and our PFS that we were working on for Cactus, the best asset that gave us the best returns was Cactus East, which is the underground component at the Cactus mine. And it's 28 million tons of just under 1% copper in the resource. We recently published a new maiden resource on Park Salyer, which is 115 million tons at 1.06 total soluble copper. That's 4 times higher in tonnage and 78% better in grade. So we decided 3 months ago to stop the PFS on the Cactus project, to give ourselves time to drill out Park Salyer into the indicated category and bring that into a substantially rescoped PFS in the second half of 2023. And ultimately, we believe today that Park Salyer is going to be the core foundation that we build this project and we build this company up from as we go forward. We already have water permits in place to take water for the next 50 years to 2070. We can take water at a rate of 3,800 acre feet per year, and there's 340,000 gallons in an acre foot. When we do the water balance on the PEA, the maximum water we use is 1,200 acre feet per year, so lots of excess capacity. And the good news is that immediately 2,000 feet below surface, there's a very strong aquifer known as the basement fault, where we're going to be able to take our water from, and I'll talk more about that shortly. The key thing to note, however, is that these water rights are transferable. So Ivanhoe Electric has not secured water rights. I'm not saying that they're not going to get water rights, but they still have to attain them, and then the next question becomes, do they actually have access to water? So if we're not using all of these water rights, we do have the ability to transfer them to other projects in the area. We've now applied for the industrial permit, the mined land reclamation permit. Once those are administratively accepted, we would anticipate in the next 6 months to have those permits in hand. The key thing to note about this project is it's all on private land. There is no public or BLM. There's no federal involvement, no federal nexus. So we're only dealing with the state and the local municipal authority, which means that once a project application, a permit application is administratively accepted, within 6 months, the regulator must give you a response to the permit. So when I joined the company, we had an aquifer protection permit only on the surface stockpile, and it needed to be amended for the pit layback at Cactus West and Cactus East underground. We put the application in October last year. Within 1 month, it was administratively accepted, so November. And in March of this year, we had the physical permit in our hand in our Tempe office in Phoenix. So 5 months, and within that period of time, there was a 30-day public consultation period where no concerns were raised by the public, either with ourselves or the regulator. So the regime in which we're conducting our business gives us a much stronger social license than other areas perhaps throughout the state. We've been conducting bottle roll tests and column tests for the last 2 years. On the oxide material, both on surface and in the pit, we get 90% copper recovery. And from the enriched material, we see a 73 to 78% copper recovery. The other thing to note is with the sulfide, obviously it contains pyrite and it self-generates a weak sulfuric acid. That's why you see the net consumption of acid actually go down when compared to the gross consumption. That's quite important because obviously sulfuric acid in a heat leach operation is a big cost driver. So Rio entered the company because they have this Newton technology. As I described earlier, they believe that they can take this to a commercial application. And the column tests are now physically underway. The computer modeling predicted 220 days would be required to see leaching times and recoveries in excess of 72%. We would expect at the end of the first quarter next year, with 120 days under our belt, to see the first results coming from those columns. And if they're at 30 to 35% recovery, we can extrapolate on the copper recovery curves to say in another 100 to 150 days, we should be up to 75 to 80+%. If that happens, the company can then start negotiating with Rio on the potential for a commercial agreement. The other key thing to look out here is that we've advised Rio that if the QP accepts this technology and it shows signs of success and it goes into a PFS and then a bankable feasibility in 2024, this technology is not project financeable, given it's so cutting edge and it's not being used in any other commercial application. So Mr. Rio, you're going to have to put your hand in your pocket and assist us with project financing. And they haven't blinked and they haven't balked at that. So it's too early yet to get into detailed negotiations. We've got to make sure we put the horse in front of the cart and see the real physical column test first. but there's a wonderful opportunity before the end of next year to announce positive results on this, and Rio is going to stand their ground when it comes to project financing. And as a junior moving a production, your first production asset into production, project financing obviously is a big risk. So here you can see a 4-kilometre cross-section across the deposit. Now, on the left-hand side with Park Salia, between Park Salia and the open pit, there's 1 kilometre of strike length that's never been fully explored. ASARCO did drill there, but the holes that they put in were essentially 300 feet deep condemnation holes. So this has never been tested to depth. The top of the mineralization here is 1,000 feet below surface. They drilled holes on the northeast extension. They hit mineralization 1,000 feet below surface. Best hole was 47 feet at 3% copper. They walked away because it wasn't near surface, it wasn't open pittable. And below the open pit, when they mined here, they only drilled 200 feet below whatever bench they were mining. And since we acquired the property and we weren't building a concentrator, we've had no interest in drilling the primary sulfide. So when the drill bit goes through oxide and through the transitionary enriched and comes into primary, at $65 a foot, we shut the drill bit down and we move to the next hole. If all of our exploration targets were successful here, here, and here, in the next 2 to 3 years, we've got the ability to add another 2 to 3 billion pounds of copper in the ground in Arizona on private land with access to water, and Robert Friedland immediately south of us with Ivanhoe Electric. Today, we currently trade at a price to NAV of 0.39 times, well below the median for our peers. If you think about our enterprise value, 100 million US market cap, no debt, 25 million in the bank, 75 million EV, 6.5 billion pounds in the ground, it's under or close to 1 cent a pound of copper in the ground. Ivanhoe Electric is getting 7 cents. That's a $1 billion US company today that is years away, 10 years plus away from production. And of course, if you look at the Filo and the Foran minings, they're at 16 cents a pound. When we compare ourselves to our peer group, we believe that there's a lot of upside here. The one criticism we've always had of the project to this date in time has always been that the scale and the size is relatively small. I believe with Park Salia coming into the equation now, you're going to see annual production in excess of 50,000 short tons and a mine life that will now exceed 25 years. If the Newton technology works, and it's a big if, it's 75 to 100,000 tons of annual production, and the mine life goes in excess of 30 years. It's interesting that when Friedland IPO'd, BHP Billiton put 75 million US dollars into Ivanhoe Electric and is a 5% shareholder, and on our property, we have Rio Tinto. If you put these two properties together and you think of this from a district size scale, in the next 2 to 3 years, you're going to have in excess of 20, maybe even 25 billion pounds of copper at in and around 1% on private land with access to water in the heartland of the Arizona Copper Belt. And that concludes our presentation. I see I've got about a minute left, so happy to take any questions.